Hi, I'm Bill Brooks, Boulder, Colorado. Wanted to talk to you today about some people wonder about withdrawal rules for IRA distributions. And everyone who has a traditional IRA must begin taking required minimum distributions, whether you're the original owner, a spouse, beneficiary, or a non-spouse heir. The rules all have one thing in common. If you don't take out enough, the IRS is going to charge you 50% of what you don't take out. So let's talk briefly about these topics to kind of give you an overview. So again, when the original owner of a traditional IRA reaches 70 and a half, they must start taking distributions by April 1st of the year after they turn 70 and a half. Then all subsequent distributions must be taken by December 31 of each year. That could mean that in the first year there could be two distributions, so you could back up one of those distributions in the prior year so that you only get one distribution per year. To calculate the RMD, you have to take the account balance on December 31st of the preceding year, and you have to divide by the factor from the IRS table. Usually it's Table 3, called the Uniform Lifetime Table, found in publication 590 on irs.gov. This factor is based on your remaining life expectancy. And so singles and most married owners use Table 3. The exception is an owner with a spouse who is more than 10 years younger and is the IRA's sole beneficiary. They would use Table 2, Joint Life and Last Survivor Table. Generally, you don't have to take money out as fast with that table. A spouse has two options when inheriting an IRA: roll the money into their own IRA or remain a named beneficiary of the inherited IRA. If he or she rolls the account into their own IRA, they will not start RMD distributions until they're 70 and a half, and they'll use Table 3. A widow who stays a named beneficiary won't take RMDs until her, let's say, in this case, late husband would have turned 70 and a half years old. Then she must take distributions based on her life expectancy, which would be Table 1, which all beneficiaries use. Non-spouse beneficiary heirs start RMDs the year after the original owner dies and uses Table 1 for their RMD distribution, and for each subsequent year the non-spouse heir subtracts 1 from that factor. Non-spouse heirs who mistakenly take RMDs as if they were the owner or spousal beneficiary will take out too little. Then they will have that 50% penalty for taking out too little. If I can help you with this, don't hesitate to call me. I'm at 303-447-1626. Have a good day.